Hello there, my name is Caitlin Marsden, and today I will be giving a 5-minute presentation on financial literacy. Understanding credit scores and credit reports is necessary for anyone wishing to establish credit, whether this be a credit card, a retail account, or a loan. A credit report is a record of your credit activity, which includes all of the necessary information needed to evaluate your financial health. The report includes a detail of past and current debt outstanding and how regularly you make your payments. Your credit score is a number that is calculated based on your financial info from your credit report. Credit scores provide lenders with the information they need to determine if they should lend money to you. Credit scores range from 300 to 850, with scores of 720 and higher being ideal. Your score is determined by 5 factors: payment history, outstanding debt, duration of credit, number of inquiries, and types of credit outstanding. Some words of advice for managing your credit cards. First and foremost, stick to one card. This makes it easier to keep track of your payments. Only charge your card if you know you'll be able to pay it off in full each month. Otherwise, you'll be charged interest, and this can add up quick. Look for cards that have a low interest rate and no annual fee. Don't get distracted by the rewards that some companies offer. Low interest rate and no annual fee are what you're looking for. Be sure to pay on time. Late payments may earn you a late fee and higher interest rates. It's best to pay a few days in advance just to make sure everything goes through. Also, do not exceed your credit card limit. This adversely affects your credit score. The top 3 goals for budgeting are thus: 1. Pay off your debt. The debt with the highest interest rate should be paid off first. 2. Create an emergency fund. Most experts recommend 3 to 6 months worth of living expenses in your emergency fund, just in case. And 3. Save for retirement. It's never too early to start saving for retirement. Making a budget is simple. You can find free budgeting worksheets online. Once you find one that you like, begin gathering information. Look at your previous bank statements to get an idea of your finances. Then, calculate your monthly income and your monthly expenses. Categorize your expenses into fixed amounts, such as rent and utilities, and variable amounts, such as clothing and groceries. Then, you subtract your expenses from your income. If your expenses are greater than your income, then you either need to cut expenses or earn more income. Before you consider buying a car, make sure you can afford it. Review your monthly budget and ask yourself, is the car a want or a need? If it's a need, remember, cash is your best friend. If you can pay in cash, then you'll not have to pay any interest. If you don't have enough cash to buy a car, make sure you finance a car that you can pay off in 48 months or less to avoid owing more on the car than it's worth. Also, don't forget that owning a car means you also need money for fuel, car insurance, and maintenance, all of which will affect your monthly budget. Buying a home is serious business. Make sure to take careful consideration of what you can afford. When buying a home, a down payment of 20% is recommended. This shows the lender that you are serious about the mortgage, which can lead to better financing. This will also cut down the costs of your monthly mortgage. A good rule of thumb is that your mortgage payment should be less than 25% of your monthly take-home income. Also, don't forget to estimate the cost of owning a home when determining how much you can afford. This includes home repairs, appliances, and property taxes. Investments are monetary assets purchased with the idea that an asset will provide income in the future or will be sold at a higher price for a profit. Several investment options exist. The least risky investments are treasury bills, money market accounts, and certificates of deposit. These earn you low rates of return, but you probably won't lose your money. These are preferred for money that you will need in the short term, which is less than 5 years. Then come bonds, corporate bonds, and municipal bonds. Bonds are less risky than stocks and mutual funds, but they can lose their value if they fall out of favor with investors. Bonds usually pay periodic interest, so they can represent a good source of cash flow. Lastly come funds. Mutual funds, index funds, and exchange-traded funds. Funds are typically riskier than bonds, but less risky than owning individual stocks. It's never too early to start thinking about retirement funds. There's 2 ways to go about it: individual retirement accounts and company-sponsored retirement plans. For IRAs, there's traditional IRAs and Roth IRAs. IRAs allow individuals to direct pre-tax income towards investments that can grow tax-deferred. No capital gains or dividend income is taxed until it is withdrawn. For company-sponsored retirement plans, there's 401ks, Roth 401ks, deferred benefit pension plans. In company-sponsored retirement plans, a retirement plan in which both an employer and an employee make contributions into an account each month is made. The contributions are invested on behalf of an employee who may begin to make withdrawals after retirement. Thank you for watching my presentation. I hope you enjoyed. Have a beautiful and blessed day.